Hi everyone, welcome back to the US CPA classes for regulation exam. In this video, which is part 4 of gross income for individual, we are going to cover income from waiver of debts, foreign earned income and other income. Other income includes scholarship income, fellowship income, bartering income, hobby income, alimony and separate maintenance. So let's dive into to understand all such category of incomes.
Right? But in what all cases it should not be treated as income. If you look at last column, the cancellation of debt for gift. If you are gifting someone, then it is not treated as his or her income. Second, cancellation of debt under the provision of insolvency or bankruptcy. Third is cancellation of debt under the Paycheck Protection Program of Tax Relief Act 2020, which is like during the COVID time, they come up with this special provision, especially for the people whose business has significantly impacted. That if they have been like not able to pay and there is some waiver on account of any government scheme, so that should not be considered as taxable in the hand of recipient. Cancellation of certain qualified student loan. So this also comes under the CARES Act 2020. So Donald Trump, when come up with this CARES Act 2020 at this point of time, so he come up with the relief package for the student loan as well. I think $5,620 per student per annum of the waiver of loan he has announced from 2020 to 2025. So which we'll be studying in future also. But this is talking about that the cancellation of certain qualified student loan, which is being qualified as per the CARES Act basically. Next is a qualified purchase price reduction given by the seller. So, like the future purchase price reduction given by the seller will not be considered as part of the income. So that will be taxable, or you can say consider as low cost of inventory in future when he or she is purchasing. Next is cancellation of debt if paid by cash basis taxpayer is otherwise deductible. So, like as we discussed earlier, in US for individual, it is optional whether you wanted to go for a cash basis of accounting or you wanted to use accrual basis of accounting up to certain limit. Like for example, I think 26 million and above if you have like business income from farming, so you need to go with accrual. Same way, like for the different businesses, there is some threshold to it. But it is possible that one person like might be using cash basis of accounting, or one person might be using accrual basis of accounting. So for cash basis of accounting person, any income is being due, or I would say any income is being considered when it is being received, or any expense is being considered when it is actually paid. So here in this case, especially in case of cancellation of debt, it says like the cancellation of debt if paid by a cash basis taxpayer is only deductible. That means if I am using cash basis of accounting and you are using accrual basis of accounting, you just simply write it off, right? Or but I have not actually done any settlement with you, then that expense will not be allowed for you, right? That will not be considered as you can say deduction for you, exclusion for you. But if I have also settled and I have also write it off from my book, then it will be considered as settlement in your account. Next is cancellation of qualified farm indebtedness. So this qualified farm indebtedness also came in the CARES Act 2020. Same way like these days in India, you might be seeing a lot of farmer protests, right? So farmer is always be, like the center of politics across the globe, to be very honest, right? So every year, like the government of United States of America, they also give a lot of relief or waiver of loans or waiver of interest for the many farmers, right? So that is generally, like considered as non-taxable when the government do the waiver of the loans or maybe interest on the loan. Next is cancellation of qualified real property business indebtedness. So if you remember in the COVID time, like the properties, people were, struggling for their survival and for their lives, right? And they were not much investing money into the property. They were not investing much money into the market. Rather, they were holding the money for in the insecurity, I would say, of the life, because in the COVID, everything, especially in the Medicare or health domain, has bumped up to super expensive prices, right? So people were not spending money on real estate or other luxurious expenses, but rather than they were holding the money for to protect their life. Right. So, again, during the CARES Act, because, like Donald Trump is also himself is a big real estate person. So if you see like in US, many of the expensive towers are named as Trump Tower, and in India also you'll see like a lot of luxurious villas and towers are being Trump in the name of Trump Tower, and Donald Trump is the owner of those properties basically, or his company is being owner of those property. So he's always been considerate of like real estate people, because he also come from the real estate background. So like he announced the relief under the COVID Care Act for cancellation of qualified real property business indebtedness. So it also comes under the COVID Care Act, in which like he has issued like the relief to those real estate people who are being suffering through the indebtedness, by giving the waiver of some indebtedness during that time. Next is cancellation of qualified principal resident indebtedness. So as the name says, like principal residence, where like individual is staying along with his or her family, right? And this also came under the COVID Care Act, especially during the COVID time provision. The person who has like one single home, and in which he or she along with the family is being like the principal residence of the individual, is considered as a principal resident of individual, right? And for that principal residence, if he or she has taken any home loan, right, or home mortgage loan, right, and on that if there is any interest due, or if there is any EMI dues during the hard time of COVID, so certain EMIs and interest has been waived off by the government. So this is talking about that specifically under the CARES Act, and those should not be considered as part of the income on which the individual need to pay taxes. So more or less, waiver of debt or cancellation of debt is taxable. However, like when it is being specifically mentioned under any act, specifically I would say under the CARES Act, then those amount or those reliefs or those benefits received by the individual is not considered to be tax. Right? The taxpayer must file a form 982, reduction of tax attribute due to discharge of indebtedness, and section 1082, basis adjustment, to report the exclusion and corresponding reduction to certain tax attribute, right? So the person who is claiming such benefit, he or she need to file form 982. Any doubts so far? Income from waiver of debt or cancellation of debt? Clear everyone? Or any doubt? Hmm? So far so good. Shall I move on?
Yes, sir.
So, yeah, next is foreign earned income, right? So foreign earned income. What is foreign earned income? Any idea? Or do you remember from any of our past discussion if you have touch base?
So related to individual who is being considered as a resident for the
Mm-hmm.
period, and
Mm-hmm.
accordingly they are eligible to pay tax on their income wherever whether it's for within
mm,
from US or outside US boundary.
mm,
So the transactions or income which is outside the boundary geographical boundary of United States, it will be
mm,
considered as a foreign income.
mm,
And accordingly, there's going to be, I think, we're going to discuss the law, what all things will be taxable and what are the exclusions from those income.
mm, mm. Yeah, no, very good. Anyone else would like to add something? Hmm? No? Okay. Yeah, so more or less, yes, like what you said is like absolutely right. So, just for simplicity, for the benefit of everyone to understand, like foreign earned income. So, like as we are studying taxation of United States of America, so we all need to look at from the U.S. citizen angles or U.S. resident angle, or you can say the people who are staying in U.S. from their perspective, right? So, any income which is being earned outside the United States of America is called foreign earned income for the citizen as well as for the resident of United States of America, right? However, there are certain exclusion and benefits is also available on foreign earned income, right? So if you see in the table over here, foreign earned income is the income which individual receive for services rendered in foreign country during the period he or she meet the following condition. So, any income which is earned outside the United States of America is being considered as the foreign earned income if he or she meet the following condition. The first is he or she has a tax home in the foreign country. And he or she meet either a bona fide resident test or the physical presence test of the foreign country, right? So what is tax home? First, let's understand that. So tax home in a foreign country is the place where an individual regularly live in the foreign country. If he or she does not live, then the place where he or she works regularly. So that place is called or treated as tax home for that individual, right? Second topic which we have touched base, if you remember here, the second point was he or she meets either the bona fide resident test. So what is bona fide resident test or physical presence test? To qualify for the exclusion or deduction as a bona fide resident, an individual should be either a US citizen or as a resident alien who is a citizen or national of a country with which the US has an income tax treaty in effect. Any idea what is income tax treaty? Anyone would like to share what is income tax treaty between two countries?
Sir, it's been an agreement between two nations, those who uh, agree to follow that
Mm-hmm.
to avoid double taxation or sharing of tax deducted at their land,
Mm-hmm.
are giving the advantage to the citizen of other country where
Mm-hmm.
they have been either temporarily earning or they were
Mm-hmm.
moved for certain time period
Yeah.
and they get taxed over there.
Mm-hmm.
It's
Yeah.
like an agreement. Not all the countries are having such
Mm-hmm.
kind of treaty. Only certain
Mm-hmm.
nations with US has been signed.
Mm-hmm.
So
Yeah.
they give the advantage. The resident get advantage of that.
Yeah. Very true. Very true. Very nice. So I think you
It's
covered almost all. Yeah.
it's like double taxation avoidance agreement
Yes. Yes.
done with other countries,
Yeah.
and the benefits are being shared. Once the
Mm.
tax is paid in another country, the benefit is being given in the country with
Yes.
the having double taxation avoidance agreement.
Yes, absolutely right. So both of you are like absolutely correct. So like just to reiterate what both of the gentlemen has shared and summarize for the benefit of everyone. is double. This is tax treaty or maybe double tax avoidance agreement is like interchangeable word which is being used in the tax language basically. So it is basically between the two countries to avoid the double taxation for an individual. Let's assume we all are like citizen or resident of United States of America. So just look at from our angle. If we have any foreign income, right? And as we are a citizen or resident of United States of America, for us, like worldwide income is being taxable in United States of America, right? But when we earn any income in foreign country, those country also being charged taxes from us, right? So to avoid this double tax, so there's the both the country do tax treaty or double tax avoidance agreement. Right. So, under this double tax avoidance agreement or tax treaty, if you are paying taxes in foreign country, so you can take credit or benefit of those taxes in your home country. So that is, like the in a layman language is a tax treaty among two countries and the benefit to the individuals of the respective country. Right? Everyone comfortable? What is tax treaty or double tax avoidance agreement? Okay. So now take you back to the original question over here. So they are saying like foreign earned income benefit is being available to the individual who meet the following condition. The first is he or she has a tax home in the foreign country, and second is he or she meet with the bona fide resident test or physical presence test. So tax home in foreign country we discussed is that home where he or she is living or where he or she is working. Bona fide resident test. To qualify for the exclusion or deduction as a bona fide resident test, an individual should either a citizen or resident alien who is a citizen or national or the national of the country with which US has an income tax treaty in effect. Right? Why only citizen and resident alien? Because for the non-resident alien outside United States of income is not taxable in United States of income. Only for citizen and for the resident alien, the income outside the United States of America is also being taxable in United States of America. That is the reason there are 2 points only, citizen and resident alien, right? And then next is key factor to consider the bona fide resident test. Deduction and exclusion are the length of stay. Second is nature of job of an individual. So physical presence test is basically when individual physically presented in a foreign country or countries for 330 full days or more during the period of 12 consecutive months. Make underline this word 12 consecutive months. He or she qualify for the physical present test. Second is like nature of job we were discussing should be permanent, not temporary. The US citizen and US resident alien worldwide income is taxable in United States of America, and the type of foreign income include earned income or unearned income. So earned income include salary and wages, commission, bonus, professional fees, and tips. And unearned income is more of like the in which an individual is not much actively engaged, like for example, dividend income, interest income, capital gain, gambling income, alimony, social security benefit, pension, annuity, right? So those kind of incomes are considered as unearned income. And variable income could be your business profit, royalty, rental, scholarship, and fellowship. So now coming to the summary of this entire, like the column is foreign earned income is taxable in the hand of resident or citizen of the United States of America, and they need to pay taxes, right? However, there are certain exclusion available, right, to consider the entire income taxable in United States of America, and that exclusion is being available when you met these two conditions. The person must have a tax home in the foreign country or must be having a bona fide resident or physical presence in the country outside the United States of America, right? And then what is the foreign tax home where individual is living or they are working. And bona fide resident test is basically to qualify for the exclusion deduction of bona fide resident, an individual should be either a US citizen, resident of United States of America, and the key factor which you need to consider for a bona fide resident test is stay. Length of the stay, that is more than 330 days in 12 consecutive months. And the nature of job should be permanent, not temporary. Clear on this box? If you move on to the right hand side, the taxpayer can claim exclusion from foreign earned income and exclusion of foreign housing or deduction in the foreign housing. So if an individual meet these two criteria, that means he has a foreign tax home plus he or she meet with the bona fide resident test of United States of America, right? In that case of scenario, he or she can claim for the foreign earned income exclusion. That means his or her foreign earned income should not be included in the income to be taxable in United States of America. Plus the exclusion of foreign housing or deduction for foreign housing. That means certain rental expenses which you are paying in the foreign house, that is also being eligible for exclusion. So exclusion from foreign earned income of US citizen and resident is up to $120,000 for 2023, and this keep on changing every year based on the inflation index in current year from his or her worldwide income. In addition, a US citizen or resident taxpayer may qualify for exclusion or deduction of foreign housing for certain foreign house amount. So there are two exclusions. One is $120,000 state. The second is on the housing, right? So to claim any of the above exclusion deduction, a taxpayer must meet all of the following three conditions. First is must have a foreign earned income. Second is must have a tax home in foreign country. Third is must have one of the following conditions. First one is US citizen must have a bona fide resident, that means more than 330 days. US resident who is a citizen or national of the country with whom US has tax treaty and who is a bona fide resident, right? Again, 330 days in last 12 months. Third is US citizen or resident who is physically presented in a foreign country for at least 330 days during the period of 12 consecutive months. Make sense? Similar condition which you have studied here in the left hand box. Note over here is individual foreign earned income from working on temporary assignment in foreign country is not qualified for exclusion or deduction of foreign earned income. And individual foreign earned income from working on infinite assignment, that means permanent assignment, is in the foreign countries qualify for exclusion or deduction of the foreign earned income. So why we are studying foreign earned income? Two things. So all foreign earned income are being considered as part of the income of individual except when an individual meet this following condition. So then there is exclusion of $120,000 per annum from foreign earned income plus the certain housing expenses, right? So that is the reason we are studying the foreign earned income. Any doubts so far? Yes, no. Are you guys here with me?
Sir, anything about
Mm-hmm.
person working remotely, like
Mm-hmm.
during the period of COVID,
Mm-hmm.
people were working from home, and
Mm-hmm.
then this scenario of freelancing is also been introduced and very
Mm-hmm.
popular. So people
Mm-hmm.
sitting in US working for
Yeah,
assignments
then
from
physical
other countries.
resident test will not, like not fit. So then the foreign earned income will be taxable in US. So I got your point. For example, an individual who is a citizen or resident of United States of America, and he or she is might be working for any project for let's say Europe, UK, India, or maybe Taiwan, right? while he or she is staying in United States of America during that time. Right? So in that case of scenario, he or she will not meet with bona fide residence test, which is 330 day out of 12-month consecutive.
So in that case, because he is resident and staying at the same time in US, his
Hmm.
foreign income will be considered as income. Obviously, it's his income, but
Hmm.
he will have a challenge of getting deductions from that income
No,
because
he will
of.
not. For example, you are a tax consultant, let's assume,
Mhm.
right? And any of your client come with this situation that, like because of COVID, we all were working from United States of America. Otherwise, supposed to go to Europe for this work, right? So in
Right,
that case of scenario, this 330-day condition is not maintained
right.
for staying outside. So then he or she cannot take this exclusion benefit.
Mhm.
Then he or she has to add his income as a foreign earned income into the total income. But if he or she has paid any taxes in foreign country, for that he will take foreign tax credit.
And for that, we need to have look at the list of countries where we have treaty with
Yes,
US.
absolutely, absolutely.
Okay. And in case US doesn't has a treaty, then
Then
is there any relief for individual?
no, I think then it's your loss. For example, like when we go to the US, right, and we pay Social Security or Medicare, so it's a loss for us.
Yes, yes. Right, right.
Yeah. Yeah.
Okay, sir.
Mm.
So it will be from our side, it will be suggestion to
Yeah.
our client that
Yes.
please avoid working with a country where US don't have a treaty,
But
or there could
like
be.
there are two, three things, like one is, like they can form like two things possible. One, if they are working, let's assume they are working in Accenture or maybe like Cognizant or Capgemini, right? And then they are working for any foreign country project. So for them, like they are receiving the salaries or maybe like the compensation from US company, even though they are working for any outside US project, right? So in that case of scenario, this foreign earned income concept will not applicable, right?
Yes.
Second scenario was like freelancing you were discussing, right? In that case of scenario, I would say maybe form a small like S corporation or sole proprietorship. So and then you can withdraw the salary from them. So you need to do like tax planning in that case of scenario.
Okay, sir.
Mhm. Right. No, very, very good question in terms of, like practical experience and practical challenges, which, like many clients will be coming up with many questions on us. Right. Good. Okay. So eighth is other income. So other income include scholarship, fellowship, bartering income, hobby income, and then alumni and separation maintenance and military combat. So quickly let's go through this one by one. Scholarship and fellowship. Basically, there are two type of scholarship or fellowship. One is purely for education. That is like for example like GRE exam or maybe like some student has passed some specific exam and basis the passing of that examination on the respective universities or maybe the government has provided certain scholarship to the student that his tuition fees will be waived off or your books and supplies will be waived off, right? So that is generally not considered as taxable income in the hand of the recipient, right? When it is for tuition fees, course fees, books and supplies. But when it comes to like rooms or launching, boarding, right? So that is being considered as taxable in the hand of recipient. Second is scholarship and fellowship received after performing some specific services like training, teaching, right? Any amount paid to the non-degree, that is taxable. Like for example, in many IITs, I have seen to the PhD students. Basically, they get fellowship and scholarship kind of thing. But they are being responsible for managing certain labs. They are being responsible for taking certain classes. They are being responsible for to monitor the exams, right? So when they are rendering some service, and against that, if they are receiving any fellowship or scholarship, that is considered as taxable income, right? Make sense? Clear,
Sure, sir.
everyone? Hmm? Next is bartering income. So bartering income, any example any of you would like to share, or any experience you may have on bartering income?
Uh, when there is a receiving for providing services in form of
Hmm.
kind, not in
Hmm.
cash.
Hmm.
Like
Yeah.
sometime people go for like the computer software developer company, and they'll go for providing some services to the customer. And
Hmm.
in the end, the customer like you would say that I don't have cash to pay you. Can you are allowed to take this equipment, or you can use already developed software in case you
Hmm.
want. And in
Hmm.
that case, they do the settlement
Hmm.
toward the services. That that
Hmm.
is considered the bartering.
Yeah, yeah. And same way, like in this news industry also, there are like a lot of bartering happen. For example, like New York Times might be exchanging with some media house, like they can give the coverage in their newspaper, and in correspond to that, they can give the coverage in their news channel. And like otherwise also, like for example, like very small example, let's assume there's a dentist, right, who charge normally, let's say, $500 for maybe root canal, right? And there's one, let's assume, any painter, so he wants to get his root canal done. So like they get into an arrangement that I'll paint your office, and in exchange of that, if you can do my root canal. So that can be like considered as a bartering transaction, where one side the painter is providing his services, and on another side, doctor or dentist is providing his services, right? So then, in such case of scenario, the question came, at what value they both need to recognize the income, right? So that is the fair market value. So barter income at the fair market value of goods or services received in exchange of goods and services provided. So what goods and services, fair market value of the goods and services which you are receiving. So that is being considered as your taxable income. Barter exchange are required to file Form 1099 for all transactions unless they meet certain exception. Next is hobby income. Any idea what is hobby income? What is hobby? Right? Like it may be singing, it may be dancing, it may be painting, right? Or it can
Sir,
be,
unless until it is been converted as a full-time profession,
hmm, yeah,
till that time it is considered as a hobby income.
yeah,
Like
but
occasionally giving tuitions classes, or occasionally uh, performing at somebody's like
hmm,
office scenario or in hotel
hmm,
or business,
hmm,
and
hmm,
keeping it as a part-time or just for a casual.
hmm, yeah, yeah. So the good thing is that in IRS has put the measurement stick on it, right? Till what extent you can consider this as your hobby, and beyond that, it will be considered as business. So hobbies are like same which we were discussing: dancing, singing, or maybe some athletes, right? Or maybe paintings, or maybe other creative things, right? But when it can be considered as a business income, so till the time it meet this following condition, it is considered as hobby income. But once the hobby income meet this following condition, it is considered as a business income. So first is profit earned in 3 out of 5 consecutive years. So in the 5 previous year, out of those 5 years, 3 years you have earned profit on the hobby income. Second is in case of hobby is like breeding, training, uh, shows, racehorse, and those kind of activity. Profit earned should be for at least 2 out of 7 consecutive years. So for normal hobby like music, singing, dancing, painting, right? So 3 out of the 5 previous year, if you have earned a profit, then it has to be considered as business income. Or in these specific kind of hobbies, 2 out of 7 consecutive years is being considered. If you are earning profit in 2 out of 7 years, then those would be considered as your business income, right? Clear, everyone? If the taxpayer wishes to consider hobby income as business income, despite of the fact it is not meet any of the above condition, then burden of proof is on taxpayer. Very simple. The next one is alimony. So if you remember this topic we have touched base couple of time earlier also, and again this came in TCJ Act introduced by Donald Trump, right? So I don't know whether I
Sir,
shared this story. Mm-hmm.
I'd like to go back to the hobby
Mm-hmm.
income calculation. In this case, it is if it has been considered a hobby income, so it will it going to be taxed as an ordinary income and
Okay.
expenses be allowed?
Yes. Yes.
Because in case you treat it as a business income, then it is already a business income and
Yes.
expenses will be allowed.
Mm-hmm. Yes, you're right.
And is there any separate form of reporting hobby income, or it's going to be
Yes.
in
Yes.
10,
No, it's a
1040 itself?
no, along with 1040, there's a separate schedule.
Okay.
Hmm. So same way like how we have schedule C for business income, we have schedule D for capital gain income, we have schedule F for farming income. So there's a separate schedule for hobby income as well.
And accordingly, the if we are being an agent for our client ongoing basis, we should be keeping a record like 5 to 3 years or two out of 7 years to be considered as a business income, or we should be informing or we'll be asking the question from our client how long you've been reporting this, and we should be
Yeah.
checking their past reports as well.
Yeah, so maybe two things, like when you file the tax return, you'll definitely requesting the previous year tax return, how it has been treated. And second, you'll definitely making inquiry. And third, you'll be taking a letter of representation from the client also.
Okay.
Mhm. So next one is alimony income or separate maintenance payment basically. So if you remember like earlier also we touched base this point, Donald Trump, like he already got divorced 4 times, right? So what was the challenge he was facing, that alimony has come as an expense into his income tax return, and all the time like new wife demand more than previous wife. So he was being very frustrated with this alimony provision which were there in earlier tax law. So what is said like any divorce decree which is being received after 31st December 2018, and basis on that divorce decree, if there is any alimony payable or receivable, so it should not be considered as income in the hand of person who is receiving or exclusion in the hand of person who is paying. So any alimony received or paid for the divorce decree received before 31st December 2018 can be considered as income in the hand of recipient and exclusion in the hand of person who is paying. But any divorce decree which is being passed after 31st December 2018, neither it is considered as income of the individual who is receiving, nor it is considered as exclusion in the hand of individual who is paying, right? So that is before December 2018 and after December 2018 are two different treatments. So alimony received based on the degree awarded before 2018 is included in the income and paid as exclusion of income. If you see right hand side box, however, any alimony received or paid based on the degree awarded after December 31st, 2018 is neither considered as income nor considered as exclusion. Any receipt or payment toward the child support, right? This is altogether different. Even for divorce degree awarded before 2018 is neither included in income nor considered as exclusion. So child support was never ever be part of income, and in future also it is not part of income. Child support is not an element. Transfer of property between the divorcing spouse in exchange of release from the material obligation, marital obligation. Marital obligation. Obligation is non-taxable. The basis of the transferred property to the transferee will be the same as it was to the transferor. So here is three things. One is child support if you are paying for either a divorce decree before or after. It is never ever being considered as taxable income in the hand of recipient, or it is not considered exclusion in the hand of the person who is paying. Second is if you are transferring any property under the divorce decree for the full and final settlement. In that case of scenario, the person who is receiving the property, what should be the basis of property in his or her hand, right? So the basis of property will be the original basis in the hand of transfer. Make sense? Clear, everyone?
Yes, sir.
Next is military combat. So military combat, like any idea what is military combat, or have we discussed this topic before?
No,
No, sir.
Uh, so military combat means like if you see like overall like the globe, we'll see like U.S. military is being deployed in many countries. Like if you see in Taliban, they have
yes,
just
sir.
like jumped out of it. It was out of control. Same way in Iran, Iraq, Saudi Arabia, maybe like here in Indonesia, Malaysia, Sri Lanka, or you can say Philippines, Vietnam, or maybe this NATO. Because of NATO, now they have military base in almost 20 plus countries, right? So when those military go into the war zone, right, and they get some hardship allowance, right, on when they are working in different country, right, so then they get some hardship allowance. So that hardship allowance is called military combat pay, right? So excluding entire month pay plus hostile fire or imminent danger pay received, or resilient bonus plus hospital medical expenses support during the combat period. So during this combat period means when they are in war zone or outside the United States of America in different land, right? So they receive normal income as well as military combat. So normal income is taxable, but the combat pay which they are receiving on account of hardship, hostility, hospital or medical support, those all are not considered as taxable income. Deadline for the tax payment and filing is also extended for service person in combat zone. The person who is in the war zone, right? If he or she is not in country, for him or her, there is a special exclusion that he or she can file the tax return after coming back to the United States of America, even though for future, even though for multiple years, right? There are like many militant who are living in like combat zone, especially if you see in Taliban, Iran, Iraq, those kind of countries, right? Turkey, right? So despite of the fact they can file the return when they are returning back to the United States of America if they are in a war zone. And any hardship allowance are not considered as taxable income in their hand. Make sense?
Yes.
Sir, this is only for deployment to out of US, or it can be or deployment within US at a certain geographical
Mhm.
location which is having a hard terrain.
Mm-hmm. Yeah, yeah. So, even though within the US, if they are being deployed in any, hard area, like for example, in India, let's assume like Leh, Ladakh, Jammu, Kashmir, which is considered as like hardship area, as well as, like it's a border area, which can be anytime converted into like war zone also. So similar to that in United States of America. Also, if they have like taking care of border protections and there is some tensions and problems in the borders, then answer is yes.
Okay.
Hmm. Okay. Oh, okay. I think this cancellation of debt. Uh, okay. Yeah. So yeah. So cancellation of debt, which we were discussing earlier. I think we did one illustration earlier. Similar to that, this is in terms of loan, right? So there's some journal entry over here if you see receiver and lender. So for example, your client is a receiver of loan for $100,000 and there is Mr. X who has given the loan. And if you see in the left hand side is the journal entry in the hand of the recipient and right hand side is the journal entry in the hand of person who is providing the loan, right? So when the recipient, like your client, has received the money, so he or she might have posted the journal entry cash account debit to loan payment, right? And later on, it is got, they are getting into a settlement, and in the settlement, they are canceling, they are reaching to a settlement of $60,000 payment. So in that case of scenario, he'll be removing the loan payable of $100,000 by debiting it, and cash he or she is paying $60,000, and then there is an income on cancellation $40,000. On the other side, lender will book the loss. So generally, the cancellation of debt is an income in the hand of person who is taking the benefit. But if you have taken a loan or if you have taken a credit line for purchase of machinery or equipment or any fixed assets, right? So in that case of scenario, the difference, the benefit will be reduced from the basis of asset, right? So if you see the another example, example number two, you have purchased a machinery of $100,000 and you have payable of $100,000. So machinery account debit to loan payable $100,000. Second, you reach to a settlement for finally making a payment of $60,000, right? In that case of scenario, your journal entry will be loan payable account debit to cash to cancellation gain of 40,000. So $40,000 is your gain. But this gain will not be taking directly to the P&L as your income. Rather, you'll be adjusting this gain against the value of machinery. So your third journal entry would be cancellation gain account debit to the machinery from which the gain has been received. So you'll be reducing the value of machinery so that future depreciation will be less. Right? In the seller account, the journal entry is same. Loan receivable to sale of machinery, cash account debit, loss account debit to loan receivable. But in the case of buyer, it will reduce from the value of plant, machinery, or equipment which you have financed. Make sense?
Yes, sir.
Right? When seller cancel a buyer purchase indebtedness, the buyer can generally avoid income recognition by electing to reduce the basis of property. So it is, good tax advice rather than treating this as income. It is better to reduce the basis of asset. so that in future, over the period of time, the depreciation will be reduced. You will not be paying taxes in the first year itself, right? So discharge of debt due to debtor or borrower insolvency or federal bankruptcy law is generally not included in gross income. So this we have discussed earlier also. If there is a waiver of debt or cancellation of debt on account of bankruptcy or insolvency, then it is not considered as income. Shareholder cancellation of the corporation in debt is tend to be a contribution of capital. If you have taken any loan from shareholder and the company is not able to pay, right, and shareholder cancel the debt, so it is considered as contribution to the capital. Make sense? Next is student loan by some state or tax exempt charitable organization. So cancellation of debt is excluded from gross income. TCJ exclude any income resulting from discharge of student debt due to death or disability or discharge of student loan after 2017 before 2026. There are two things. One is when state government waiving off the student loan. So then it is not considered as taxable in the hand of student. Second, under the TCJ Act, if the bank or any NGO pay or any bank cancel the debt of student loan in case of death of the student or in case of any disability of the student, that is also not being considered as income in the hand of student, right? So resident of United States of America must report all income regardless where it is earned, right? So far we have covered all general income, right? So let me take you back really quick. And these all are illustrative income, right? So you may have like other type of income, but like in exam, normally these kind of income which we have experienced in last 10 years is coming in your examination, right? So you can make a point that there may be other sources or other type of income possible. The answer is definitely yes. But in our book or in all the study material, we are being more focused for examination purpose. So what is being like normally tested in examination as per the blueprint issued by AICPA, that we are covering here, right? So we have covered wages, salaries, and tips. Then we have discussed interest income, dividend income. Then after we have discussed today the rent and royalty income, gambling income and losses. Then today we have covered income from waiver of debt, foreign earned income. Then we have discussed about other income, which includes scholarship and fellowship income, barter income, hobby income, alimony, military combat, cancellation of debt, and yeah, so this is all about routine income, right? So maybe here we can take a break for 20 minutes and then we can start with other categories of income. So far, if you see, we have covered two categories of income, capital gain and general incomes, right? Now we are covering the special categories of income after the break. So it's like around 11:40. So, oh, sorry, 10:40. So we can come back at 11 and then we can continue from the new topics.
Sure.
Okay.
Sure.
Let's come back at 11.